It's just an update. Most of you know judges, so I'm not going to go into big descriptions. So what I wanted to really is just to explain what we did in this first half. Everybody remembers we had a difficult year in 16. We won't go back to the reason why, which we speculated a lot why it did happen. So we had a good half of good recovery with 14% organic growth, a bit more than that in actual growth because we had about 20%, and we had a very good year in terms of acquisition. So as much last year was our worst year in trading, but it was our best year. We did 4 deals, and all of these deals we're really happy with them. We had the highest order book we've had at 16.5 weeks. So this is up on the previous year, but it's also up on the 1st of January, and that's quite unusual. And organic orders are up 28%, so that's quite a good time. And of course, when the sales are up, there's big gearing. We've discussed this before. We reckon that every additional pound of sale will generate about 60 pence of profits. So we've had good growth. So of course, we've had good acceleration of profit. So we're up 43%. And earnings per share, which is the thing we all like, is 65% up because, of course, as usual, we haven't issued a lot of shares. It's an exercise of options with a big incremental, in a minor fashion every time. So we've generated a lot of cash. Another feature of our sector is we buy companies which don't have a lot of fixed assets, and they don't have a lot of current assets either. And so we can get a lot of growth without having to put money back in the till to say financing growth. We don't need to finance growth. I think in the balance sheet we have about 8-9 million of net current asset for about 60+ million of sales. So a lot of the cash goes straight in the till when we have profits. And this year we had a good time. We had I think 99% cash conversion. So this has enabled us to increase the dividend by 10%, a bit more, but you all know we have actually publicized policy of increasing the dividend by at least 10% every year. So we've managed that for the 11th year. We started, our first dividend was the interim paid in the summer, in respect of the first half of 2006. So it's the 11th time we do that. We've had some steeper steps, but we've always managed minimum 10%. So everybody says I'm mad to publicize it, but it's a good target to publicize. But of course, if you want to publicize it, you have to have it well covered, and it's well covered. It's always much better covered at the interim stage, I have to say, but if the broker's forecasts are met, we'd be still 4 times covered. So if you calculate the visibility of that, even if you don't have any increase in earnings, you could still increase 10% per annum for 14 years without running out of money. So that's quite good. I'm not sure we would do that. We would start thinking, do we have a business? Well, I wouldn't do that. If we have no growth for 14 years, I think I'd be long retired, or somebody will retire me. But it's quite comfortable to say that we have enough to produce the 11 we've done plus another 14 years. It's 25 years of increasing the dividend by 10%. So that's quite good. So now we paid 10 pence, or we will pay 10 pence. I'm not sure we actually paid it yet. So we have moderate net debt, but of course we did a deal just in July, so the debt is actually more than it was at the end of the period, but we had quite good reduction. And then, of course, we did a deal, so I'll come on to that deal in a minute. So really, that's the slide number 1. And slide number 2, you've seen that many, many times. It's the 12.5-year financial history. And really, this is the thing we care about. So we want to have more sales and more profit. That's obvious, but that's easy. But more per share is more difficult. It's the northeast one. But mostly it's the bottom one, which is really the key. Do we generate enough money to pay back the bank so we can re-borrow and also to pay an increasing dividend? So that's the bottom one. And it also shows the measure of how bad was 2016. How bad is a disastrous year for us? Well, it still enabled us to repay a lot of money to the bank and to pay our 10% increased dividend. And so did 2014, if you have very good specs to look at 2014. And of course, we still, I mean, the performance of this half hasn't affected the compound annual growth rate over the last 9 years because we don't do it by half years. So we still have to satisfy ourselves with 8.6%. But of course, you know, we did a bit better there. So we're getting a bit back towards the 2 figures there. So why did we have a good performance? Because we had more sales. And why did we have more sales? We had more orders. Okay, so orders is the thing which drive it all. So on slide 3, you have on the left a slide you've seen very, very often, which is the order intake. And by the way, this is a slide we have for each company every week. So that's really the heart of the business. Have to get these orders. And really, I remind you, because you've probably forgotten, the red line is our budget. We only re-budget ever when we have an acquisition. And so that's really, it's the sales budget. And if you don't, in the last 12 months, if you don't actually have enough orders to meet that sales budget, well, either you don't meet your budget, or then you end up that period with less order book than you started with, which is not a very good sign. So you see that black line, which is the trading 12 months, in the run-up to the end of June, was well above the red line. Actually, we only needed to be above the red line at the end of the year. Because every time we do a deal, the red line goes up very fast, but the black one stays where it is. And the green one shows you the trading 7 weeks multiplied by 3. So it's really 4 months. Why do we do 4 months? Because, you know, typically our order book is between 2 and 4 months. And so if you've had 4 good months of order intake, all your factories are going to be really functioning really nicely. So that's why we really follow this one. Of course, it's a lot more erratic, but mostly you see the big slump in the first 5 months of last year, and really the quite solid recovery since June of last year. June was a good month.
David, while we're talking about sales and orders, apologies, I'm sure you've answered this before, but is your price list in euros and dollars, or is it in sterling?
Well, we have 11 different business units. They have their own habits that we don't change just for that reason, that we own it. So, you know, we sell a lot in sterling, but we sell also quite a lot in dollars. And a fair amount in euros. So when you're selling in euros and you're selling in dollars and sterling tanks, it's very good because you don't have to do anything. Okay? Well, there's some very sophisticated customers come and they tell you, well, you know, can't you make a bit of an effort because really, it's a big, you know, you make a lot of money there, but I'm not making a lot of money, so we need you to do. It doesn't happen very often. It happened in one instance I can think, but they are very sophisticated, of course, American. But of course, when we're selling in sterling, which is like more than half of our sales are denominated in sterling, then of course it's a battle for many reasons. First, you only benefit with time if you increase your prices, because you have your order book is already done. You can't change the price of an order.
But it clearly makes you more competitive if you stand before.
Yeah, we're more competitive, but we prefer actually having higher margin and being less competitive. But it takes a long time because you have quotes out, you have tenders, you have your order book, and then it takes a bit of time to get the confidence of increasing your prices. And really a lot of the budgeting process last year in September, when already we had quite a few months of low sterling, was just comforting the MDs that really they had to get their prices up because sterling was down 18%, and people wouldn't even notice if they put their price up 18%. Of course, nobody did 18%, but it's a process, and it's been very good for us. Currency has been fantastic for us, no doubt about this. But you see the recovery in orders. We've had a good time in orders since June last year. We've said that the first few weeks of the second half were like the second quarter. You have, can't tell you more on what has happened since, clearly. And then we put on the right a profit bridge. We started doing that last year. Because you remember we had 3 companies underperforming. So what we do is we went back to the organic contribution last year, which contribution is before the cost, the central cost. And you see organic growth has produced a big slice of the improvement. You had some companies underperforming in a minor fashion, which is, we see a very small arrow going down, and acquisitions, which haven't contributed so much compared to last year. Because a lot of the 2 biggest acquisitions were in March, so we've had another half of the half year. And this shows really how we've improved. And finally, our favorite slide, which is ROTIC. So this one, I think it needs a bit of explanation. You all know what the ROTIC is. I just remind you, it's the EBIT contribution to profit and central costs. It disregards central cost. And it's really the actual, it's pound on pound. So everything when we buy a company, we count the cost of buying the company, plus all the fees and the lawyers and the accountants. Everything we spend is counted there, and we don't depreciate the intangible assets for that purpose. So if you put a pound in the bank and you want some return on it and the bank gives you 0.4%, that's the money you make. If you start depreciating your pound, then of course the banker looks more and more generous. It's easy to get a good return. So that's what the accountants tell us that we have to do, and we do it for the accounts. But when we calculate the ROTIC, we take back this depreciation, we put it back into the denominator.
So that's EBIT after the amortization charge? Or?
No, we ignore the amortization charge, and we ignore the amortization in the denominator. So it's basically you invest a pound, you want to make 20%, 25%, and the denominator doesn't change, except if we're using more money, if we're using more assets. And historically, we virtually, if we look at the sum of all the business we bought, and the denominator is the same figure. So we haven't really added to these assets that we use. And of course, R&D was a very important driver of our business. We don't capitalize, so it's not an investment for that purpose. So we've seen we had a very good period, and we all know how well we did until 2013. In 2012, we had a step down. So every time you buy a big company and you pay a higher multiple, this time was GDS, we paid 6 times. You sort of blend your 16.7 return to what was there before. And we have another step a year later. And then Armfield, we paid 5 times, so it was less steep. But of course, then we've had the difficult performance of 16, and we still have a very unsatisfactory, in our eyes, 17%. And of course, we're still carrying, this is done on a trading 12 months basis. So we're still carrying the second half of last year in these figures. So we hope there's still a bit of momentum.
Oh, you said you paid 6 times for GDS. Was that EBITDA or EBIT or?
EBIT. Yeah, we ignore EBITDA because we believe that depreciation is a cost.
Yeah.
Looking back at that difficult period in 2016, do you have looking back with the benefit of hindsight, can you understand exactly what happened there and see it?
Yeah, well, we've explained. We had 2 companies which suffered from poor demand. One of these companies is Armfield. We said who it was. We never comment on which one it is, but because it was inorganic, it was quite obvious which one it was. So we wanted to save everybody the effort of retro-engineering our accounts. We attribute a lot of it to the price of oil and commodities because we sell a lot to countries which are really very rich in commodity and not rich in other monies. And it's recovered very nicely in this year, so that's good. Then there's another company which we didn't name, which sells a product which is really an accessory for another product. So it's a sort of OEM sales. It's a big market and a very expensive piece of equipment. So we sell the accessory for that. And last year was very dead. And so our sales were also dead. There's not much you can do. And then there's another company. So this has also recovered very nicely in the first half. I can't say that Armfield, there's a lag in everything. So we're not saying Armfield is where it was last year. But there's a very good recovery, and in particular, very good recovery in order. So in order, it's sort of back to normal. We said there was one company which we didn't name for commercial reasons, which had production problems, and we put a lot of changes. So we really started to burn us in July. We put some changes in, and then we gave the management until the end of the year to sort it out. And in February, we decided to change the management. We sent our COO, who's very good at operations, to sort it out, and he's still there. It takes a long time. Yeah.
And has any of this educated you in terms of where you'll be doing the next acquisitions, in terms of what the underlying markets might be?
No.
No? Okay.
I wish it had, but look, we're always, very critical of ourselves. Yeah. When we see, there's something, of course, we learn a lot of stuff about, one particular company is not doing well. What is it? What happened? And we're very forensic about this. But I can't say will guide us with acquisitions. Sometimes you have companies, we have 11 business units, we bought 16 companies. This is the first time we had operations problem, which were worth talking about to our shareholders. It's a sizable thing, but it doesn't happen every year.
Okay, thank you today.
Yeah, thank you.